Most first-time investors think they know what they're looking for when it comes to property investing, but the reality is they haven't got a clue. They're shopping around like it's their dream home, looking for a fresh coat of paint, a brand new kitchen, new carpets, new flooring, perfectly landscaped backyard. Those things I just mentioned do not drive returns. In fact, they do just the opposite. So I've been personally property investing since 2018. I've personally purchased almost 50 properties for clients, and all the properties that underperformed had this one single thing in common. This one thing that I didn't check. And to give you an indication as to what the downside is here, if you miss this, on $1 million property, this could cost you anywhere from $200,000 to $250,000. And if you scale that to a $2 million portfolio, you could be almost $500,000 down. And that's the real price of getting this one thing wrong. In this video, I'm going to share with you what separates the men from the boys, what separates the winning property from the one that's a dud. I'm going to show you exactly how to check it before you buy. And most importantly, I'm going to show you the numbers as to why it matters and why it matters more than anything else you do. But the first thing we need to clear up is the biggest misconception that's costing Aussie investors hundreds and hundreds of thousands of dollars. And respectfully, if you've never invested before, you don't know much about property investing. You might know how to pick a nice place to live, nice kitchen, bathroom, liquor paint, beautiful big backyard with nice landscaping. But the truth is, that's the exact opposite of what makes a good property investment. And most beginners I know shop for a property investment as though they're shopping around for their dream home. And don't get me wrong, I've made this mistake myself. I sunk over $50,000 into a nice looking property that did not serve me well at all. But I've now bought almost 50 properties. It's 43 for clients and 6 for myself across Australia. And I can tell you right now, the nice looking ones are not the ones that are the most profitable. Not at all. In fact, it's the exact opposite of that. I've had the wins, I've had the losses, I've invested in houses, in apartments, I've invested regionally and in capital cities, and I've seen enough for me to speak on this topic, I think. What you need to do is stop shopping like a homeowner or with your emotions and start thinking like a property investor. Stop looking at things through the lens of, would I live here? Because it does not matter. You are not living there. You are never living there. You may not even visit the property. By the way, I built a tool to make things like this a little bit easier. It's called the Investor Property Checklist. It's the exact checklist and the exact process I use when I'm reviewing deals and reviewing properties myself. It's free to download. The link is in the description. So what is the question we should be asking ourselves instead? Let's talk about the one factor that decides whether your property appreciates in value or doesn't. Most investors haven't got a clue that when they buy a property, their money is going into two different places. And only one of those things is actually making them money. One is the land and one is the improvements to the land. The term is called land to asset ratio. So the land to asset ratio tells us what percentage of your dollar is tied up in the land as a proportion of the overall purchase price. So for example, if you had $1 million purchase and $300,000 goes into your land, you have a land to asset ratio of 30%. That $300,000 of land appreciates at roughly 7% per annum or 7% per year compounded. The $700,000 in the building or in the improvements is actually losing value over time. It could be fully depreciated and not losing value at all, but it is either stagnant or it is dropping in value. So you have two opposing forces. The improvements that are depreciating and the land which is appreciating. But what percentage or is the vast majority of your money going into the land or the improvements on the land? If the property is still an 80s or 90s built brick home, but it's been freshly renovated inside, you're likely going to be paying a premium for those improvements. I would always much rather buy a bigger block with a more original, older home on it than a smaller block with a newer home or one that is renovated or done up, one that I'm paying a premium for the finishes. There's a reason why we get depreciation benefits when we buy renovated or brand new. That is because we are literally, quite literally, losing money. Just remember this, the higher your land component, the better your capital growth will be in the long run. Now you're saying to me, JP, surely a few percentage points can't make that big a difference on the long-term growth, can it? Well, let's run through it. I'm going to show you exactly how much money we're talking about here. People ultimately think that a few percentage points or the difference between a 4 or 6% capital growth rate doesn't matter too much. It's still going to go up over time, JP. What's the big deal? Well, those few percentage points compound into huge astronomical differences. And the other thing is, most people don't get the opportunity to purchase 3, 4, 5, 6, 7, 8 property investments in their lifetime. Most people have the opportunity to buy maybe a few. So it's not just about what performs, but it's about what performs best. It's about opportunity costs. So we're going to run through an example just to demonstrate this. We've got two purchases, both cost us $1 million. Two properties, both $1 million each. Property A, property B. Both in good areas, both seem like solid investments. Property A is a newer house on a smaller block, and property B is an older house on a bigger block. On the house with a lower land to asset ratio, so the newer house on the smaller block, 30% land to asset ratio, after 10 years is worth $1.22 million, and the house with a 60% land to asset ratio after 10 years is worth $1.54 million. That equates to a difference of roughly $320,000 on the same spend. Now, you might tell me, JP, there's holding costs involved with the older property. Fair enough. Let's take $120,000 off the top. That's at minimum a $200,000 difference on just a single $1 million purchase or a $1 million asset value. If you're holding $2 million worth of property and you have a portfolio, that gap doubles to just over $400,000. So making the wrong decision in this regard is at very least going to cost you in the order of hundreds, if not millions of dollars if you have a big property portfolio in the long run. And that is why land to asset ratio is my number one metric and is not just a nice to have. It is literally the difference between compounding growth and compounding your wealth and doing the exact opposite. So before you buy anything, make sure you calculate your land to asset ratio over a 10-year period. Run these numbers on every single deal without fail. If the land to asset ratio is too low, walk away. There's always another property, there's always another deal. But what you can't get back is 10 years of poor returns. Most investors think that once they've done the land to asset ratio due diligence, their job is done, but that couldn't be further from the truth. There are also physical characteristics about the property that can lead you astray. They will seriously impact your returns and lots of people ignore them. What are they, JP? I'll give you an example. A client of mine bought a property a few years back in Southeast Queensland in one of the most blue chip locations in all of Brisbane. They did their high level due diligence checks, but the one thing that they missed, a critical part that they missed, was they didn't realize that they'd bought a property in a flood zone. Interest rates started rising. They tried to offload the property because they needed the money and they simply could not get their money back. They couldn't even get the price that they had paid for it. They ended up taking a $120,000 hit on their purchase price, plus their stamp duty, plus their agent fees. All of these things took a massive chunk out of their investment. They ended up being in the exact opposite position they wanted to be from property investing, and they are scarred for life. They lost in the order of hundreds of thousands of dollars, and they could have avoided it with some simple checks. So yes, beyond land to asset ratio, there are plenty of other due diligence points that you need to check. So what are some of those key checks and balances? Well, number one is we of course want to avoid main roads. Why? Because of noise, because of traffic, and because of safety. So it's going to impact not only your capital growth, not only your tenancy, but it will also impact your ability to resell and exit the asset if you needed to. The other thing we want to avoid ideally is properties that are on the low side of the street that are sloping away from the street. Why? Number one, they generally don't have as nice street appeal. That's the first thing. The second thing is if you ever decide to develop on that block or you want to sell that block to a developer, it's going to have drainage issues and it's going to be less appealing to that type of buyer. So it is just a better option in terms of exit strategy, and you will likely demand a higher price. You will also probably pay a higher price on the high side of the street or on a flat block as opposed to one that is sloping away from the street. We also want to avoid super irregular shaped blocks. Now, a little bit of irregularity is okay. Blocks don't have to be perfectly rectangular or square, but the reason we want to avoid those is simply because the usability of the land is not as strong. What do I mean by that? If your property has all these weird angles and shapes cut into it, it might be a 700 square meter block, but maybe only 500 square meters of that block might be usable from a development perspective. It also impacts our ability to put a secondary dwelling a lot of the time, or do a dual occupancy or a duplex, or build two houses on the one block, right? Development upside may not be important to you today, but it may be important to someone who might buy the property in future. As time goes on, council tend to loosen their development restrictions over time because there's more population, there's more people, and they tend to allow higher density. So they tend to loosen their development restrictions, allowing you to do more with the piece of land that you once weren't able to do anything with. Some other big red flags, of course, are things like avoiding bushfire zones, avoiding flood zones, avoiding when there's an easement or a council asset or a sewer running through the middle of your block. Avoid major intersections. You don't want to be buying right on a roundabout, for example, as well. All of these things can have an impact on your ability to resell, get tenants, and your capital growth. So, what actionable advice do I have for you? We want to always be walking the property and the street, and we want to know it so well that we know what it's like at different times of the day. It's not enough to go through and check on Google Maps, the street view. That will not paint an accurate representation of the property. You want to know about noise pollution. You want to know about the slope of the land. You want to check the block shape. You can actually check this on Google Maps from the bird's eye view. But the rule of thumb is if it fails basic livability, then do not buy it. Great land to asset ratio will not save a fundamentally flawed property. So yes, land to asset ratio might be the first filter, the first checkpoint, and definitely the most or one of the most important. But it's only one piece of the puzzle, albeit a big piece of the puzzle, and part of something much bigger. But seriously, I'll show you the exact process I use to buy 40-something properties for clients and 6 for me and build a $6 million portfolio before I hit the age of 33, and how you can apply it to your own. So the link is in the description. You know the one check that you can't afford to skip before you buy a property, but even the best check will not save you if you're buying in the wrong area. That's why in the next video, I'll show you exactly where I put $100,000 to work today. And I'll explain why some locations set you up for success and others will hold you back. Click through the link to check it out.